Aloha students, and welcome to the lecture on Chapter 17, Job Order Costing. In this chapter, we're going to first distinguish between job order costing and process costing, which are two main methods of costing or categorizing costs. Then we're going to calculate predetermined overhead allocation rates and then allocate overhead costs to projects or jobs. We'll look at the concept of over and under allocated overhead. And then finally, we'll look at job costing for a service company. So first, distinguishing between job order costing and process costing. What's the reason that we want to do costing and find out what the cost is for one unit of product? Well, we need to know how much something costs in order to determine what the selling price will be. We obviously want to sell a product for more than it costs to make. So again, figuring out the cost of one unit helps us to set prices. Also, we're going to need that information to compute the cost of goods sold and the cost of inventory, cost of the ending inventory specifically on the balance sheet. And we'll see how we do that later on. So here's an example of what unit costs, the types of examples of unit costing. So for example, manager of fast food restaurant needs to know what the cost is to make a single cheeseburger, so that, again, can help determine what the price of that cheeseburger is going to be. Same thing with freight service. So manager of freight service needs to know how much it costs to transport 1 pound of freight 1 mile. And again, that way can determine the pricing. Automobile manufacturer obviously needs to know the cost of making a single car. And different model cars have different cost levels. Construction firm needs to know the cost for building a particular house, again, for pricing purposes. And then an accounting firm, they need to know how much it costs them to prepare a tax return. And again, some tax returns are more complicated than others, so there's more costs that go into that. So again, for pricing purposes or determining prices, they need to know what the costs are. Okay, there's two main costing systems. We're going to look at job order costing in this chapter, and we're going to look at process costing in the following chapter. Job order costing is appropriate for products where the costs can be accumulated by job, by project, by product, some kind of discrete, separate category or classification. So if you can divide up what you do, what your business is, into segments, then job order costing is appropriate. So job order costing is used for the production of unique products or specialized services. Again, things or your work, what the business is all about, if it can be divided up into segments or compartments or projects or jobs or segments of its business. Process costing, on the other hand, accumulates costs not in jobs, but by steps in the process of making the product. Usually these costs are accumulated by department, okay, or by major process. Process costing is appropriate for those companies that make a single product and they make that over and over and over again, so there's no way to segment the company's business. Since they don't have segments, we have to accumulate costs by departments or steps in the process. Okay, so whether it's job costing or process costing, there's 4 steps to tracking product costs. accumulate, assign, allocate, and adjust. And we'll talk about these individually. Okay, so looking at the flow of product costs in a job order system. Okay, so notice that you have a separate record of each individual job or project or segment. And notice again the three different types of costs that go into manufacturing costs: direct materials, direct labor, and manufacturing overhead. So you separately keep track of those on separate records or job cards or job cost records. Okay, so they're individually recorded by jobs. If you were to look on the balance sheet, you'll see the total of each job goes into work in process inventory. When the job's complete, when you're finished making it, it's no longer work in process inventory. So you take the costs out of work in process and transfer them to finished goods inventory, okay, because now they're done. They're no longer in process. And then when those finished goods are sold, we take it out of finished goods inventory and put it into cost of goods sold. Okay, so that's the flow of job costing. Okay, the concept of predetermined allocation rates. Predetermined overhead allocation rates. Notice the word predetermined. That means that it is done before the period starts. Okay, so we're going to be ahead of time determining what overhead rate we're going to be charging to each job or each project. Okay, and obviously because it's predetermined, that means ahead of time, we're going to have to use estimates in order to calculate the predetermined overhead allocation rate. We're not going to know what the actual amounts are till the end of the period, but we need to know how much overhead to allocate to jobs during the period as the jobs are being done. So we can't wait until the end of the period to get the rate of overhead to charge. So we need to estimate that amount so that we can allocate or charge overhead to jobs during the period as they're being worked on. And then at the end of the period, then we know what the actual amounts are going to be. So at that point then, if the actual amounts turned out to be different than the estimated amounts that we used at the beginning of the period, then we need to adjust the overhead. Okay, so the predetermined overhead allocation rate is basically, the formula is, the numerator is the total estimated overhead costs. So you, again, at the beginning of the period, you need to estimate how much overhead cost they're going to be. And then you divide that by the total estimated quantity of the overhead allocation base. So whatever the way you spread out the overhead is going to be, that's the overhead allocation base. Okay, so these are typical cost drivers. In other words, how we spread out the overhead. We may spread out the overhead based on how much direct labor hours a job uses, or direct labor dollar amount cost. So those two drivers are appropriate for labor intensive production environments. So if a process uses a lot of labor, then direct labor hours or direct labor cost would be appropriate bases for spreading out the overhead. On the other hand, if there's a production process that uses a lot of machines, then perhaps machine hours would be a good way to use as a basis for spreading out overhead. Okay, and these are selected by management, and they try to choose a basis or a driver that is most appropriate for their type of business. Okay, so let's take an example. So at the end of the year, Smart Touch, which is a tablet manufacturer, estimated that the total overhead cost would be $68,000 and the total direct labor cost would be $170,000. So if we're using direct labor cost as the base in determining predetermined overhead allocation rates, then your numerator, $68,000 total estimated overhead cost. Denominator would be the $170,000 estimated quantity of labor dollars. So the predetermined overhead allocation rate is 0.4 or 40%. Whenever you're dividing, whenever you use direct labor cost as the driver, and you see you have a dollar amount divided by another dollar amount, you're going to end up with a percentage. Okay, so in this case, 40%. Okay, so now that we know what the predetermined overhead allocation rate is, oops, let me go back to the previous, sorry. We know how much overhead to allocate to a particular job or a project by taking that predetermined overhead allocation rate and multiplying by the actual amount of that base that we used. Okay, so again, as an example, this Smart Touch Learning, their direct labor cost for this particular job, 27, was $1,250. So how much overhead should be charged or allocated to job 27? Well, we saw in a previous slide that the predetermined overhead allocation rate we computed was 40%. It's indicated that job 27 used $1,250 worth of labor. So 40% of that $1,250 worth of labor is $500. So that's how much overhead we're going to be charged or allocating to job 27. Okay, so that's how we allocate the overhead once we get the predetermined overhead allocation rate. Okay, so this is a typical job cost record. Notice they have the three categories of costs: direct materials, direct labor, and then this manufacturing overhead. Notice the $500 that we just computed with the predetermined overhead allocation rate of 40% of direct labor cost there that we computed. So we get the total cost, direct materials, or the total of all these materials used, $2,750. Direct labor is all the labor used. This comes off of time cards or time sheets, $1,250. And manufacturing overhead, this is the allocated amount using the predetermined overhead allocation rate, $500. Add them all up to get a total cost of $4,500. Let's say we made up here 15 tablets. So divide by 15, you get $300 per tablet. So that's the cost of making this tablet with this accounting software built into it. $300 per tablet is the unit cost. So we know we have to sell these things for at least $300. And we want to sell it for more, obviously, if we want to make a profit. Okay, so what happens at the end of the period? We used estimates to charge jobs for overhead because we needed that number ahead of time as we did jobs during the month. So what happens at the end of the month when we actually get the actual amount? So here's manufacturing overhead, and these are all the actual costs that are accumulated in this account related to manufacturing overhead. On this side, on the credit side, 67,600 was the amount we charged to the jobs based on our estimate. Okay, we thought the estimated amount was going to be 67,600 based on the predetermined overhead allocation rate. It actually turned out to be 83,000 for manufacturing overhead. So before the period, again, we determined the predetermined overhead allocation rate. Then during the period, as we did jobs, you remember that we used that predetermined overhead allocation rate times the actual quantity of the base that we used. So as we were doing jobs, we got actual quantities, and then we applied those for each job against the predetermined overhead allocation rate to get the amount of manufacturing overhead allocated to the job. So at the end of the period, if the actual costs were more than the estimated amount, so this allocation here based on the predetermined overhead rate, so if the actual cost turned out to be more than the amount of overhead we allocated or charged to the job, then we call that under-allocated manufacturing overhead. That means not enough overhead was charged to jobs. So if that's the case, that means the cost of goods sold would then be under-costed. So it wasn't enough that we charged the cost of goods sold. So basically what happens is at the end of the month, we have to adjust our manufacturing overhead account. So if any overages are in the manufacturing overhead account due to under allocation, we offset that against cost of goods sold. Okay, so in other words, actual costs are more than what we charge to jobs, so we increase our cost of goods sold by that amount. On the other hand, if the actual costs are less than what we charge to jobs or allocated, that means we charge too much. So that's over allocation. Okay, so what we do at the end of the period then is offset the manufacturing overhead, and we reduce or credit our cost of goods sold. So basically what's happening is if the actual costs are more than what we charged to jobs or to customers, then we reduce our profits by that amount. If the actual costs were less than what we charged, that means we overcharged the jobs. So we increase our profits by that amount, because we can't go back and tell the customer, oh, you know what? In the first case here, oh, you know what? We undercharged you, so can you give us the difference now? You can't do that after the fact. So it just basically you eat it. You reduce your profit. If on the other hand, you overcharged for overhead based on your estimated predetermined overhead allocation rate, then if you overcharge jobs, you're not going to, after the fact, refund money to your customers for the over allocation. So you increase your profits in that case. Okay, here's a schedule of cost of goods manufactured. So cost of goods manufactured schedule is a schedule that shows how much did it cost us to make the products that we made. In this case, the format is very important. This is a very structured and pretty much set format. So you start off with your beginning work in process inventory. And let's say in this case, it was $80,000 at the beginning. Again, work in process inventory is inventory that we started working on, but we have not yet finished. Okay, so at the beginning of the period, all those items that we have been working on but didn't finish by the end of the period, that becomes the beginning work in process for this year in this case. Yeah. Then we add direct materials used. And direct materials used, that calculation is your beginning raw materials inventory. So raw materials inventory is inventory of materials that you haven't started working on yet. Okay, it's still in its raw state. So whatever inventory, raw materials inventory you have at the beginning of the period, plus any purchases of raw materials, and that includes the freight costs. Okay. Those two numbers together give us raw materials available for sale, so the total amount of raw materials that we could use. So raw materials available for use. Then we subtract ending raw materials inventory, so any materials that we have at the end of the period that we haven't used yet, that's raw materials inventory at the end of the period. Subtract that to get direct materials used. Okay, so in indicating the direct materials used, we need to do this kind of calculation here. Okay. Then we add the direct labor. Direct labor is given to you as a total, so you don't have to do any calculations to get that. Then to that we add the manufacturing overhead incurred. So this is just all the list of all the manufactured overhead items to get total manufacturing overhead. Okay, so you add the direct materials used, the direct labor, and the manufacturing overhead total, and that gives you total manufacturing costs incurred during the year, in this case 607. You add to that the beginning work in process inventory to get 687,000, in this case, the total manufacturing cost to account for. So again, this line, total manufacturing cost to account for, is your total manufacturing cost, again, which is direct materials used, direct labor, and then total manufacturing overhead, plus the beginning work in process. Then we subtract our ending work in process inventory. So items at the end of the period that we've started to work on, but we have not yet finished by the end of the period. That's ending work in process. That gives us the line cost of goods manufactured. Okay. So in computing the cost of goods manufactured, this schedule, the format of this schedule is very important. So you just need to follow this directly. Okay. So on the income statement, notice we have sales revenues up here. This is sales. So the cost of goods sold section is the thing I wanted to focus on here. The calculation of cost of goods sold is beginning finished goods inventory. So whatever goods that you finish but haven't sold yet by the end of the period is finished goods inventories. So whatever inventory you still had on hand at the beginning of the period is added to cost of goods manufactured. And as you remember, we got that figure from our schedule of cost of goods manufactured on the previous slide. Here's the 660. So adding the cost of goods manufactured plus the beginning finished goods inventory gives us cost of goods available for sale. Then we subtract our ending finished goods inventory, whatever inventory we've completed but haven't sold yet by the end of the period. That's ending finished goods inventory. So subtract that from cost of goods available for sale, and that gives us cost of goods sold. Okay, so the computation of cost of goods sold is this format right here. Beginning finished goods inventory plus cost of goods manufactured equals cost of goods available for sale minus ending finished goods inventory equals cost of goods sold. Okay, so that's the main thing I want you to get out of this particular slide here. Okay. Okay, next let's look at the concept of job costing for a service company. So costing for service company is essentially the same as for a manufacturing company. But let's use this example of a law firm. Okay, so there's, rather than manufacturing overhead, okay, you just take out the word manufacturing because it's not a manufacturing company. So it's overhead or indirect costs. Okay, so these are all costs that aren't direct materials or direct labor. So they have a total of $300,000 of indirect overhead costs. Okay. This company uses direct labor hours as the allocation base. That makes sense because a service company they don't provide any products, so they don't use a lot of machines, so they use a lot of labor instead. So labor would be a appropriate driver to use for allocating indirect costs. So it's estimated that Walsh attorneys will work 10,000 direct labor hours in 2016. Okay, so the predetermined overhead allocation rate is the $300,000 expected, in other words, estimated indirect costs that we saw earlier there. Okay, those are again all the costs, overhead costs that need to be spread out or allocated to jobs. Okay, divided by the base. In this case, they're using direct labor hours as the base. So the 10,000 estimated direct labor hours. So you see that result is $30 per direct labor hour. So in other words, they're going to be charging $30 of overhead or indirect cost for each 1 hour of direct labor hours that's used on a job, or in this case for an attorney, each job would be a client. Yeah. So the client, they charge an hour's worth of labor, and then they would add another $30 for each one of those labor hours as the overhead. So we saw that the direct labor costs are $50 an hour. $30 an hour are is the overhead allocation rate. So let's say direct labor costs, they charge $50 an hour to customers or clients. Okay, so this particular client required 14 direct labor hours, so that's how much time attorneys spent on the client, 14 hours. So the total cost that's going to be charged to client 367 is the 14 hours times the $50 an hour. That's the direct labor, $700. That 700 should be over here. And then they charge another $30 for each hour for the indirect cost, the allocation of that overhead cost. So the 14 hours times $30 an hour is $420. So the total cost that will be assigned to client 637 or charged to client 637 will be $1,120. Notice there's no direct materials because that amount is, there's very little direct materials, maybe, I don't know, paper, I guess, but there wouldn't be very much other direct materials. So for a service company like this, because there's no physical product, nothing is actually made. Okay, it's a service. Okay, Okay, and that's calculating and using predetermined overhead costs for service companies. Okay, that's chapter 17. So until next time, aloha.